Okay, let's get started. So I just wanted to highlight before we get started, given that your assignment is due fairly soon, on the Uni Hub I did see something advertised a bit earlier. So this has got Friday the 17th for some Excel workshops, tips and tricks and that. I did notice there's a few flyers around saying that there's some other workshops around the 13th, 14th and that you can log in through your Uni Hub. So go onto that Uni Hub and have a look and see if there's any other work. They might not be on here because they might already be booked out or something, but I definitely saw flyers around saying that there was from next week, so from the 13th onwards, they've got different things on different days. So earlier on in the week it's more introductory, and then later on they had ones that were a little bit more advanced with using Excel. So if that applies to you and you want to learn a bit more, because remember I said that with your job you need to, being able to use Excel and being a very good user of Excel is quite important. So if you get a chance to go to any of those workshops next week. So just for you coming in, there's some handouts up here, up on the third thing, if you want to grab one. There are some Excel workshops next week. So jump onto the Uni Hub and have a look at when they are and the timing and whether you can book into it or not. I've definitely seen flyers. I won't tell you where I saw the first one. It was in the ladies' loo, actually. They were sticking them and then they were around on the walls and that. All right, so they were definitely starting on the 13th. So definitely worthwhile, if you're able to attend any of those, definitely worthwhile going. Okay, so this week it's part 2 of cash flows. We'll just see how we go. We've got a new question there to go through. All right, so hopefully if you've had a chance to do your homework, then you know the difference, that your cash flow is not your profit and loss, right? That your profit and loss reflects accruals, where your cash flow essentially reflects your bank account. Looking at the benefits and limitations of cash flow, we'll do a little bit more in the tutorial on that with some of the theory questions. Now we're going to have a look at another cash flow today. So in front of you is your handout. From your handout from last week as well, you had this little summary sheet of what a cash flow looks like. Now remember, in your final exam you are allowed to take in 1 page of notes, writing both sides. So I would strongly suggest you cut and paste this, shrink it, put it in the corner so that you've got it there for you, so you don't have to remember everything. All right, so that you can add your little notes and that to it. So we know that with a statement of cash flows, it is one of your general purpose financial reports, along with your balance sheet, your profit and loss and your statement of equity, and it's required to be prepared by companies that are reporting entities. So with your cash flow, it's divided into 3 main sections, just to remind you: operating, investing and financing activities. Should be fairly easy to remember where it goes, because your operating is just all your daily normal stuff, right? Just your normal daily stuff. Items of investing, obviously if it's got the word investment in the title, chances are it's investing. All right, so investing is usually to do with the buying and selling of non-current assets like property, plant and equipment predominantly. And if you've got investments in shares, then the dividends associated with those. If you've got monies invested long-term elsewhere, any interest received from those as well is usually investing. Your financing activities is, where do you get your money from to run your business? Do you issue shares or do you get bank loans, for example? All right, so your financing activities can include a number of items there. You've got your issuing shares, long-term borrowings, repayment of those borrowings, as well as any dividends in relation to those shares that you have. All right, so that's your basic format. Remember that at the end we have to total everything up. We work out whether we've got a net increase or a decrease. We've got to put in our opening balance, right? Remember, it could be a positive or it could be a negative if you've got a bank overdraft, all right? And then whatever your balance is at the end, your balance at the end, okay, must reconcile to your cash and cash equivalents. sitting in your balance sheet. All right. Now just remember, from the exam point of view, it's worth 25 marks. There is consequential marking. If your figures don't add up, you're going to lose marks. So what you must do is make sure you add up properly, because then you'll only lose the initial mark, you won't lose the later marks. Don't, for example, just put the balance here at the bottom and expect to get a mark for it. All right. However, you will get a mark, even if it's wrong, if you've added everything up correctly. All right, but you'll lose marks earlier where you've got a figure incorrect. All right, so you can obviously put it in brackets. It should be this, but I haven't been able to get it to reconcile. Remember, if you're out by $1,000, look for that amount. So look for $1,000, look for half of it, look for 500 or look for double, just to see if you put something when we've done our account reconstruction on the wrong side with your opening and closing balances. All right, and that's just a quick, sometimes you might have a couple of things wrong, it might not be just one thing, so that doesn't always work when you look for half of it and double it. Okay, so we know what our process is. We have to work out what are our cash and cash equivalents. So we'll do another example today where we've got a few more cash equivalents. So not just a bank account or a bank overdraft, there's a couple of other short-term items. To classify it means we have to decide, are the individual items operating, investing or financing? And then we determine the format. Remember, the standard does allow a little bit of choice in how you present your statement of financial. There's the direct method and the indirect method. The direct method is nicer and neater, all right, and both methods still require you to do a reconciliation of your operating cash to your profit and loss statement. All right, so we're going to do that today. So when you're doing that format, you can do both. In the exam, I will ask you to do the direct method and you will have to do the note as well. All right, so then remember, the direct method is you just have the heading operating, investing and financing. Under the indirect method, you have the note, which is essentially the reconciliation of your operating profit with all your operating items to your P&L as part of your top section. All right, so your section right at the top, which is operating activities, this is the direct method. That section is replaced with the note, essentially, under the indirect method. Doesn't look as nice and neat, but you're still required to do that note, even if you use a direct method. You're still required under the standard to reconcile. Right, then you prepare it and then any other disclosures. So potentially there are material non-cash disclosures that you may have to highlight as well, such as the impact of leasing, right? So if you've leased assets, such as the impact of exchanging if you're buying a business when you issue shares and there's no cash component to it, all right? Anywhere, maybe you've exchanged other assets, all right, and doesn't necessarily have a cash component to it. If it is material, it should be disclosed in a note. All right, so going back to your cash and cash equivalents, hopefully it should be self-explanatory that your short-term, highly liquid investments, items that have a 3-month turnaround, should be included as part of your cash equivalents there. Okay. All right, this is just a reminder on how we're going to treat it. So we're going to follow the textbook approach on how we treat interest and dividends. Right, so interest received, we are going to treat it as investing. Interest paid, we're going to treat that as operating. Dividends received, we're going to treat as investing, and dividends paid, we're going to treat as financing. Okay, we're going to keep that consistent. Remember, having said that, the standard does allow for alternative treatment if you want to treat them differently. Right, but you have to justify it and you must be consistent. You cannot change it from period to period. You just pick what you want, and what you pick reflects the nature of your business and where you think it adds the most value for your user decision making. But once you pick it, you have to stay with it. Now, something that we haven't addressed yet, which we'll start to look at today, and the example that we're going to do in class, and what the example that we're going to go through in the workshop today. So in the workshop today, you've got homework, so question 6.2. So if you haven't done it, then we're going to do it in class anyway. But if you have done it, we'll review it. Then there's a new question. All right, and that's what I'm just start to add little bits of complexity to it. So looking at your cash received from customers, we have to remember that where we've got trade receivables and we've got bad debts or doubtful debts and adjustments, and we might have discounts allowed, we might have to account for that. Okay. So also the GST attached to that is something which might need to be accounted for and reconciled. We're not going to focus a huge amount on that because you've got enough to learn as it is without doing that extra bit on the GST. Just so you know that where you have like sales returns and allowances and discounts and bad debt write-offs, that impacts the amount of GST. All right, so your GST receivable and therefore the amount that you owe the tax man, and also the which indirectly affects your cash. Right. So looking at your cash paid to suppliers, you've got other adjustments for discounts received. Looking at your purchases of non-current assets, there are potentially effects of valuation adjustments and impairment, so they need to be considered from time to time when you're recreating any of your asset accounts. So if there's been any valuation adjustments or impairments in there, they might need to be included to work out cash components for new purchases. All right, if you're recreating accounts. So dividends paid in the current year, remember we could potentially have two lots of dividends. You've got an interim dividend and a final dividend from last year, right? Because the final dividend is usually declared after the end of the financial year and doesn't get paid until the following year, all right, normally. It's very rare does a final dividend get paid prior to the completion of the account. So if your year end is 30th of June, normally they will declare that dividend probably not until September, because normally they don't sign off their accounts for at least 3 months. Obviously things are getting a lot quicker now. It might only take a month or 2 months, but the larger companies that are consolidating with corporations all around the world, it's at least 3 months before they declare that final dividend. And remember, they can't pay dividends unless they're making a profit. And you can't always work out straight away where your profits are. It's not instantaneous yet. The day will come when it is. The day will come when all your shareholders will be able to log in and print a balance sheet or a profit and loss on demand for that day, at that moment, in that second. Right, it will happen because everything will be automated. So it's not possible yet. Okay, but remember it will be an unaudited one, and that's all the issues that go around all of that as well. All right, so it's not, unless the system is in place where that audit process is actually fulfilled at the time the transaction takes place, all right, then you can't instantaneously say that that's what it is. The day will come when it does happen, all right, just not yet. The technology can't facilitate it. Income tax, so income tax expense and changes in current tax and deferred taxes is something that needs to be taken into consideration as well. So for the purposes of cash flow, when we're looking at deferred tax assets and liabilities, we'll just treat them as accounts that are either assets or liabilities. So you might have already forgotten what you did in 5013 for deferred tax assets and deferred tax liabilities. We'll do a little review on that before we do consolidations, and I'll put notes up you for your own review on those accounts. But remember, this unit is not a tax unit, and you should have already had a bit of a look at that. But bearing in mind that deferred tax assets and liabilities arise because of timing differences and the amount for depreciation, for example, that you can do from an accounting point of view compared to a taxation point of view, there are differences. There are also instances where the taxman gives you discounts, right, which can result in other deferred tax assets as well. Okay, so this is the indirect method. We need to account for non-cash items. So if we are looking at our picture your profit and loss in front of you, so from the example last week, so you've got that there in front of you. You have a look at that profit and loss. Look for all the items that are essentially non-cash. So we have got depreciation and that loss on sale of equipment. Those are definitely not hitting your bank account. Where your sales revenue, you know that does hit your bank account. So even though there could be variations there with accounts receivable, your cost of sales and your other expenses, we know that they do hit your bank account at some point. However, there could be some accruals in there, but we definitely know depreciation of plant and equipment, and that's a non-operating item as well. Remember, it's relating to plant and equipment, so it's an investing activity, as is the sale of the equipment account as well. That's an investing activity. All right. So we have to remove those items along with other non-operating items, and then we need to account for the changes in your accrual assets and liabilities. So essentially, under the indirect method, you start off with your profit in your P&L. So in this example here on that handout, you've got a profit for the year there of $39,000. You'd start off with that, right? You need to add back the expenses and minus out the revenue items that don't relate to cash, right? Then we need to adjust for non-operating items, right? Any other non-operating items, and then we need to look at the movements between the operating items in our balance sheet, the items that relate to operating items in your balance sheet. So anything to do with your accounts receivable, inventory, your prepaid insurance, your interest receivable, those are all operating related activities, right? Your investments in plant and equipment aren't, so we don't need to include those. On your liability side, you've got your accounts payable, your employee benefits, which is your wages and stuff like that. That's an operating activity, as are other expenses. All right, so we just need to be picking the operating activities when we look at that note. Okay, so we've got our statement of cash flow over the page. So on your page 2, you've got that full statement of cash flows there. We did that last week. All right, so we went through that, we worked out the operating, investing and financing activities. So now we're going to do the note. So what we're going to reconcile is that 62,000, that net cash from operating activities, that 62,000. All right, so what we have to do is, if we go to our P&L, we have to say, how did we get from our profit of 39,000 in our P&L to that 62,000 sitting in our cash flow? We have to reconcile that. All right, how do we do that? This is the note in front of you, which is on the bottom of that page. All right. Okay, so you can follow and write notes as you're going along. All right, see how we start with our profit for the period there of 39,000. All right, that comes straight from your P&L on page 1. You can put a little circle around that, the profit for the year there, 39,000. That's our starting point for the note. We're going to add back our non-cash expenses. So depreciation is definitely a non-cash item of 20,000. We're going to add back or minus out any other non-operating items. So we've got a loss on sale of equipment there of 2,000 that we accounted for, that we're going to have to add back. Right. However, we've also recognised some interest revenue. That interest revenue is treated as a financing item, so it's a non-operating item, so we're going to minus that out. Because we've included that as revenue, so in our P&L we've added it in, but we don't want it there, we want to take it out. Okay, so we're going to minus that out. We're also now going to look at our movements between our assets and liabilities that relate to our operating items. So we've got an increase there in our accounts receivable. Notice how we're going to deduct increases in assets, and we're going to add increases in liabilities. So if you look at that increase there in your accounts receivable, if you go back to your balance sheet, you can see you had an opening balance there of 43 and a closing balance there of 52. So there's a difference there of 9,000. So there's a movement there of 9,000. That 9,000, right, for our accounts increase in our accounts receivable, we're going to deduct that out. Our inventories, again, which is another asset, but this is a decrease, right? Therefore, we're going to add that. If you have a look at your inventory, it had an opening balance of 52 and a closing balance there of 50. So it's gone down by 2,000. We're going to add that in. Our decrease in our prepaid insurance. So if we have a look at our prepaid insurance, we had an opening balance of 5, closing balance of 3. The difference there is 2,000. We're going to add that back. Now we look at our payables. So we've got accounts payable. If we have a look at our accounts payable, we've got an opening balance of 32 and a closing balance of 38. So there's been an increase there of 6,000, sorry. Don't do that to me. Sorry, it's just saying it needs a restart. I just don't want it to automatically restart in the middle of the lecture. So where were we? We were on the payables. So your accounts payable, there's a variance there. It's an increase. So we're going to add increases in our liability. So we're going to add that difference of 6,000 back. Our wages and salaries, right? There's a 2,000 variation there. If you have a look at your provision for employee benefits, right, you've got an opening balance of 4 and a closing balance of 6. It's increased, so we're going to add it in there. We've also got other expenses, but those other expenses have gone down. We had an opening balance there of 3 and a closing balance there of 2, so there's a variation there of 1,000. All right, so let's go back, and we know where it's all come from. Whoops. So add it all up, it reconciles back to our net cash from our operating activities there of 62. Right, because we've started with our profit figure. We've minused out non-cash items. We've adjusted for items that are non-operating. So we've got the loss on sale of equipment and the interest revenue, both of which are investing activities. Right, so we've started with our P&L. We've taken out the non-cash items, adjusted for non-operating items, either added or minused. And then we've gone back to our balance sheet. We've looked at the movements between the items which relate to operating activities only. Right, added or minus, so we add increases in liabilities and we minus increase in assets, or the opposite. Right, we would minus a decrease in a liability and we would add a decrease in an asset. Right, so again, it's just something that you have to remember, the process of what you plus and what do you minus. You don't have to memorise it by rote, you can write it on your notes. And I always tend to just write the one side and then know that automatically it's the other, so it doesn't waste the extra space, all right, on your notes. So I would just write, you add an increase and you minus, so you just do it for either one side, if it increases or if it decreases. All right, so that is our note. So essentially, if we would do it using the indirect method, this section here would replace that operating section. And see how it looks messy? All right, it's fine to have in a note because that's what the standard requires. The standard actually requires you to reconcile your profit figure and to your operating, right, to see what those movements are. Right, it requires you to do that. But it doesn't look nice. It doesn't look as nice as the indirect method that we did last week. So that's why it's always, probably about 95% of businesses will use the direct method, all right, which means you do the direct method, which is your what you've got there on page 2 at the top. Then in the notes, you have the note, which is this, all right, so in supplementary information at the back, you show that movement. Okay. So any additional information, you might need to show your cash and cash equivalents, all right? So if you're having to do a separate note, even if there's not much in that note, the standard actually says you have to disclose what your cash and cash equivalents are. Even if it's a one-liner, you should still have that note in there, all right? As well as, like I said before, any other non-cash financing investing activities, such as the purchase of a business by issuing shares or changes in leasing arrangements and things like that. So some of the limitations there of your actual statement of cash flows. So remember I said last week, if you're going to buy a business, right, your cash flow is the most important important financial statement that you would look at. But you've got to go beyond the actual statement because statements can be manipulated. If you're buying into a business, you want to look at the bank account. You want to have a look at least 2 years' worth of bank transactions so that they hand you the bank statements and you can clearly see money's coming in and money's going out. If you cannot see, if they won't provide it to you, in a reasonable sort of time frame, then you know there's something dodgy going on. All right, because it's very difficult to manipulate cash flow data for an extended period. All right, but if they'll only give you, say, 3 months' worth, just walk away because you can manipulate 3 months' worth of data where you can manipulate transactions, manipulate electronic funds transfers, false invoices, all that kind of stuff. Right, so you really want to look at about 2 years' worth. But remember, all your general purpose financial statements, which includes your cash flow, right, is limited in the fact that it is usually quite old. By the time you actually get to look at it, it's usually about 3 months old. All right, but what it does provide is important information about your operating activities because that's your core business. Are you making money? If you're not making money from your core operating activities, and there's something going on, right? So, and also looking, the first thing that I will look at if I was going to invest in a company, I'd go to the cash flow. So first thing, look at the balance sheet, look at the assets, right? Look at how old the assets are, look at the levels of depreciation and that on them. Then go to the cash flow and see if they've spent any money on new assets, right? Because it's that's what allows businesses to make money. All right, depending on the nature of the business, obviously, but if you're going to be buying into something which relies on assets to help you generate revenue, and then you've got to look at what are they putting money into, what are they investing into. Also, when you're looking at, when you're reviewing from an auditing point of view, you want to have a look at different sorts of things that, where they're trying to manipulate things and hide things away and all that kind of stuff. So there's, lots of things that you can do through your cash flow, and you can actually pick up. There's so many things now and tools that auditors have got where they can see people that manipulating monies, moving in and out of the business and all that kind of stuff, and you can actually pick it up. You can pick up the trends. So even if the dollar amounts change, you can pick up the different trends and where monies are being filtered out through and that kind of stuff. So it's quite sophisticated now. The forensic accountants have got access to be able to do some pretty amazing things. So I always like looking at that thing. I would have liked to have done something in that area myself. So because I worked a little bit in IT, not enough to know everything anymore because everything has become so more sophisticated now from when I was doing it. But if I had a change of career now, I would go and learn how to do all that stuff, because when you can follow the money, you find out all sorts of things. Anyway, when you're doing your statement of cash flows, it doesn't always give you adequate liquidity and solvency information, particularly when it comes to areas of leasing, right? Because, however, that has just recently changed. So under the new leasing standard, all leases now are finance leases, right? And you can't look at it through the cash flow on its own. You can look at lease payments that are being made. But previously you didn't really know the full extent of the implications of leasing because they were operating leases, and businesses weren't required to disclose the full nature of those operating leases. So they could have had literally hundreds of millions of dollars in operating leases that people didn't have a full knowledge of, right? And that was a debt. But now all leases are finance leases. All leases that are over 12 months are on the balance sheet, right? And therefore require people get to ask questions about it. All right. You can still manipulate a cash flow statement. As you see with a cash flow statement, you can manipulate the timing of payments for inventories and accounts payable and things like that. So you can manipulate a cash flow statement through your operating, investing and your financing activities and that's through management operating decisions. But I mean, as can in everything, right? Everything can be manipulated, so that's a limitation of all accounting data. Having said that, most businesses are pretty good. Most businesses will do the right thing. There's only a small number out there that don't do the right thing, and they make it bad for the rest of us. Okay, so we've got a new question for you. So we're going to go through the question from beginning to the end. So which is from the old textbook, which was questions 16.9. We're going to have a look at the city. We have data there for 2016 and 2017. All right, so let's have a look at what we've got and what's actually required. So in front of you, we start off with our balance sheet. So before we go through all the cash and cash equivalents, so let's have a look. So page 3. You'll see we've got a balance sheet there. We've got past year and the current year. Just check that it balances. So we've got total assets of 722, total liabilities and equity there of 722 for 2017. We've got a variety of different assets and liabilities there. We've got your standard equity items with your capital and your retained earnings. All right, so just get a feel for the data, the current year and the past year and the movements there. We're going to have to come back to that, and at some point you're going to have to look at those differences between them. So when we get to that specifically, we get to reconstruction of the accounts. We have to look at them for the opening and closing balances, number 1. Number 2, when we recreate the note that we just did for this question, we're going to have to look at the movements, the increase and the decrease when we reconcile the profit back to our statement of cash flow, the operating section. So over the page, on page 4, here we've got our profit and loss. All right, we've got a profit there after tax of 12,760. We've got a variety of different income and expense items. All right, we've got discounts. All right, so we're going to have to account for a discount received and a discount allowed. So we've got added some complexity there. We've got some additional information. All right, so we're going to have to prepare the cash flow. We're going to use the direct method, and then we're going to do the note. So item A in the additional info, we know that there's some new equipment was purchased, of which 17,400 was paid in cash. So if something is paid in cash, we know we're going to immediately, we've got an outflow there of 17,400. All right, so you might want to put a highlight that with your highlighter as you're going through. Right, outflow. Now it's equipment. So is it operating, investing or financing? It's equipment. Okay, so it's an investing item. Okay. So operating is your normal day-to-day activities, investing is your non-current assets, financing is mostly for shares and debentures and things like that. So we know that 17,400, we're going to have a cash component there. The difference between the 17,400 and the 67,400 means that we've got a $50,000 lease as well. All right, so we're going to have to account for that when we reconstruct our asset account. Item B, equipment which cost 42,200 and had a carrying amount of 20,000 was sold for cash, but it doesn't tell you how much. All right, let's go to our profit and loss. We've got a loss there on the sale of equipment, haven't we, of 1,600. If it had a carrying amount of 20,000 and we made a loss of 1,600, how much cash did we get? That's right, we must have received 18,400 in cash. All right, so you might want to write that in there now. So straight away you know that an item was sold, it had a carrying amount of 20,000, we've made a loss, therefore we must have received less than the carrying amount. Because in order to calculate whether you've made a profit or loss on sale, it is the amount of cash you've received less the carrying amount. If you make a loss, you've received less. If you make a gain, you've received more. All right, so there's 18,400 there. We've got some debentures that were issued at a nominal value of $100 each for cash. All right, so we're going to have to work out what those debentures are. We'll do that in a minute, all right, when we get to it. But we know that we're going to receive some money because we have issued that. Is it operating, investing, or financing? Okay, so it's a financing activity because that's how we get money to run our business. Item D, we've got share investments with an original cost of $32,000 were sold for cash. All right, so we've got a gain under income. We've got a gain on sale of the share investments there of $22,600. All right, we have to work out how much did we sell them for. If we've made a gain, we must have received more. So what's the cash component? So it'll be that 32.2 plus the 22.6. All right, to work out the gain. The bank bills held and the bank overdraft form part of the cash and cash equivalents. So we'll go back to our balance sheet. Let's go back to the beginning, work out our cash and cash equivalents. We've got cash at bank, we've got bank bills, we've got deposits at call, and we also have a bank overdraft. All right, so if we have a look here on your note up here for 2016 and 2017, we've got our cash and cash equivalents. Cash at bank, 54,800, bank bills 10, deposits at call 6,400, and your bank overdraft, remember it's an overdraft, so it's a negative figure, all add up to 36,400. So this is what we are going to reconcile to in our cash flow. All right. So over the page, you've actually got the cash flow there, all right, in your handout. So you can write notes and that as we're going along. Just put a note down there at the bottom, that 36,400. All right, that reconciles to your cash and cash equivalents. All right, so let's peruse our balance sheet items and the movements there. Right, just so that you know as you're going through where there are differences, some of those differences are accounted for in the notes, in the additional items, and some of them aren't. So we've accounted for our cash, our banks, our deposits on call. Our accounts receivable have gone up there by 11,500, so we're going to have to work out the cash component there by recreating the account. But we also need to consider the doubtful debts, and in our profit and loss, we have got discounts, all right? So we've got discounts received there of 2,100 that we're going to have to account for when we recreate that account. We've also got inventory, prepaid expenses, interest receivable. Now our share investments are an investing activity. So all the other ones, those were all operating activities. All right, our share investments are an investing activity. Our land and buildings are investing activities. Notice how with our buildings, we've got a variance there in your buildings of 120,000. Have we got anything in the notes about buildings? We haven't, have we? But there's a variance. So therefore, we must have bought some more. So there must have been a cash outflow, okay? We must have bought some more. There must be a cash outflow there of 120,000. So you might want to write a little note specifically next to that one because that's not in the notes. So highlight that on your balance sheet that there's 120,000 there that we'll have to remember to come back to. Your equipment, we know we're going to have to recreate our equipment account because we've sold some items. We're going to have to recreate. So there's a difference there. To see whether we bought any more as well, so we need to recreate it to see what we've sold and whether we bought any more. And with our deferred taxed asset as well, there are movements there. We're going to have to look at our deferred taxed asset, our deferred tax liability, and our current tax to work out what is our tax component. Looking at your liabilities, you've got your accounts payable, accrued expenses, interest payable, your current tax payable. They're all operating related activities that we're going to have to include when we work out our cash from our cash payments to our suppliers and employees. The bank overdraft we've already accounted for when we've looked at our cash and cash equivalents. We do have that new finance lease. That is from item A with our equipment. All right, there's a finance lease there. That isn't a cash component, is it? You haven't actually received any cash. All right, that just is there to reflect a liability that we're going to pay. The ongoing payments for that will need to obviously be reflected when you pay for that lease. Right, we've got debentures, so we know that we've issued some more debentures. How much? So remember, oh no, don't restart. No. How do I stop this? Oh, I've got 11 minutes. Stop. Sorry? Is it? Oh, is it 11 hours or 11 minutes? Oh, no, okay, so that's all right. So I'll just thought it was 11 minutes. Come on. It wouldn't go. Okay. Go away. Oh, stupid thing. Okay. Give us a sec. Okay, done. Now, where were we? We were looking at the debentures. So item C's, there were some debentures issued, $100 each for cash. We can see there's a variance there of 30,000. So that 30,000 means we must have had money that came in. If you've issued a debenture, this is going to do this every couple of minutes, isn't it? It's going to drive me bonkers, so we'll just hurry up. Why won't that? I'll just... Okay, so we've got debentures there of 30,000. We've got a movement there in our deferred tax liability that we're going to have to recreate those taxes to work that out. We've also got we've also got a movement. Okay, we'll just try and ignore it. It's just going to drive me bonkers. Can you see that all right from where you are? Okay, so it's not blocking out anything. Share capital there's a movement there in our share capital account of 21,340. We've also got that movement there in our retained earnings. See how that 12,760 is the same as your profit after tax? All right, what that means is we haven't paid any dividends, have we? All right, so that's just a little double check for you that the only movement in there is the actual revenue. All right, the profit, sorry, not revenue, just a profit from our P&L. So when you do your retained earnings, remember you add in your profit and you minus out any dividends. Okay, so let's have a look at the next one. So you're right, are you okay with that screen size like that from where you are? Okay, so having a look at our P&L. So just remember I highlighted before that we've got discount received and discount allowed. Your discount received relates to your accounts payable and your discounts allowed relates to your accounts receivable. We're going to have to make sure that we account for those when we recreate our accounts. Okay. So let's have a look at our allowance for doubtful debts account first. All right, we have got an opening balance there, so go back to your profit and loss. We have an opening balance there of 1,900. So remember, your allowance for doubtful debts is a contra asset account. The opening balance is on the credit side. All right, 1,900. Your closing balance of 2,500 is on the debit side. We have a bad debt expense that has come from the profit and loss. If you have a look at your P&L, you'll see under your expenses you've got 2,800 there. Right, bad debts expense. So remember, if you have a provision or you have an allowance for your doubtful debts, all your bad debts get written off against that allowance. Right, that's the whole point of it. Right, pop that in there. Which side is the biggest total? That's on our credit side, adds up to 4,700. So your 2,800, add your 1,900 gives you 4,700. On the other side, we have got 2,500 as a balance carried down, meaning there's a difference there of 2,200. That 2,200, we need to flow that through to our accounts receivable. All right? So that recreation of that accounts allowance for your doubtful debts, we have to take that through to our accounts receivable account. So notice with your accounts receivable, it is an asset account. The opening balance of your accounts receivable, so if you have a look at your balance sheet, go to accounts receivable, your opening balance from 2016 is 37,800. Your closing balance is 49,300 on the credit side. Okay, we flow through that 2,200 from our allowance for doubtful debts, but remember, we've also got our discount allowed. All right, so that discount allowed, remember, because it's a receivable, we have allowed somebody discount. So it's currently in there as an expense to us, but we need to account for it in here. That discount allowed from your P&L of 950, pop that into the credit side there. We've also need to bring in our sales revenue of 1.386 million, pop that onto the debit side. The biggest side is the debit side, so your sales revenue plus your opening balance from last year of 37,800 adds up to 143, so 1,423,800. Your little T account must balance. The difference, so if you take the 143, so 1,423,800, minus out your allowance for doubtful debts, minus out your discount, minus out your closing balance, means the cash component must have been 1,371,350. All right, so that's your cash receipts from customers. Over the page on your cash flow that you've got in front of you on page 5, you can see we have got that figure. So we have reconciled that figure. So you can tick that off and say, okay, well, we know how we've calculated that. We've recreated our allowance for doubtful debts. We've recreated our accounts receivable. We've accounted for bad debts and discounts. All right. See how it just starts to pick up a little bit when you add levels of complexity. So when you're adding in that doubtful debts and you're considering, so what it means is you need to make sure you're ticking everything off when you go through your profit and loss and your balance sheet. All right. So what have we used? We have used our accounts receivable and we've used our doubtful debt. So we can just tick them off as you've gone through. Go to your profit and loss. What have we used? We've used our discount allowed, so we can tick that off because we know we've already used it in an account recreation. So what that means, if an item is not highlighted or ticked off as you're going through preparing it in the exam, what it means is that you need to look at it and decide whether it needs to be in there or not. Okay, have you missed something? Okay, and as I said before, this is the one way to do it where we're doing a reconstruction of these accounts. I prefer to do it this way because I can like I've said, I'm a visual learner, and I can visually see the movements in the accounts and the cash component. But if you're comfortable with the formula and you're comfortable that you're not going to forget that you have to adjust for your discount and for any bad debts, all right, then you need to make sure that that you can use that formula as well. All right, which is as follows. You start off with your sales, minus out the increase in accounts receivable. But remember, if your accounts receivable had gone up, you would add the, if it had gone down the other way, you would add the decrease. All right, so your signs change depending on whether it's an increase or decrease. So we've got sales minus the increase in accounts receivable, minus your bad debts written off, minus your discount allowed to give you the 1,371,000. So with your bad debts written off, that 2,200, you still have to go and work that out. All right, by making sure that you adjust for your bad debts expense. All right, so you still actually have to go and work that one out. Right, which is the difference between your allowance for doubtful debts, right, taking it off from your bad debts that's currently in there. All right, so your bad debts expense is 2,800, and the difference between that and your movement in your allowance for doubtful debts is 600. So 2,800 minus that movement of 600 gives you the 2,200. All right, but remember, you have to remember how to do that. If you do the formula, you might just take off the bad debts instead of looking at that movement. Whereas if you do the recreation of the account, all right, you automatically factor in that opening and closing balance and that movement. Okay. Next, we start to look at our cash paid to our suppliers and employees. So there's a couple of things that we need to do here. So we're going to have to account for our accounts payable. But before we do that, we've got to look at our movement in our inventory account. So we've got our opening and closing balances there from our inventory. So inventory is an asset account. Opening balance is on the debit side of 96,600. Closing balance of 94,200 on the credit side. Cost of sales, all right, comes from our profit and loss. So if we have another look at our profit and loss, cost of sales, 932,000. All right, our biggest side is our credit side. Add the 932 to the 94,200 gives you 1,026,200. Take that balance through to the debit side and work out what our difference is. So minus off the opening balance of 96,600 to give us 929,600 that we need to flow through, okay, to our accounts payable. Right, our accounts payable is a liability account. The opening balance there is on the credit side, the 93,600. Your closing balance is on the debit side, 120,520. But remember, we've also got discounts. So we go to our profit and loss. We've got a discount received. So what that means is our suppliers have given us a discount. So our suppliers are within our accounts payable. We need to account for that discount received of 2,100. So we need to pop that into our accounts payable because that's money that we're not paying. Right, the difference there of 900,900, right, is our part of our cash paid to our suppliers. So if we turn over the page and you have a look at your statement of cash flows, the figure that we want to get to is 1,325,050, isn't it? We're only partly there because we've only looked at our suppliers, all right, because it is our payments for our suppliers and our employees and other expenses. All right, so that's the first part. The second part is all our other expenses, where we're going to merge some accounts and that together to get the next bit, which is the 424,110. All right, so in order to get that 424,110, you can do the accounts separately, but what I've done is I've put them all together. So I put the assets and liabilities for all the other expenses in the one account. So you've got to make sure you get your opening and closing balances for the assets and the liabilities on the correct side. So you can see I have merged prepaid expenses and accrued expenses. So let's do prepaid expenses first. So if you have a look at the T account, our prepaid expenses, right? If you have a look at your balance sheet, your prepaid expenses are an asset account, aren't they? Right, so your prepaid expense, the opening balance there of 4,200 is on the debit side. Your closing balance of 10,800 is on the credit side. Now we've got other accrued expenses, right? We've got an opening balance there of 8,340. Notice it's a liability, so the opening is on the credit side, and the closing balance there of 9,780, right, is on the debit side. Right, so we've got those opening and closing expenses for our balance sheet accounts, but how do we get our, what expenses have we done in our P&L? Let's go and have a look at our profit and loss. Let's go through our expenses. The only other one we've got there is employee and other expenses, all right, of 418,950. So we've got to pop that in there. But in this one, it's all grouped into one, but we might have a variety of employee expenses and other expenses. So we might have to add a few different expenses in there if we've grouped it all into one, all right? And we might have more than one asset prepayment and a more than one different accrued expense type, all right? So you can see if you group it all into one, right, put the opening and closing balances in, make sure you get them on the right side, all right? Pop in the expenses that relate to those on the credit side there, work out what the cash component is. Right, this one's a little bit easier because we've grouped it all together. Seeing our cash component there is 424,110. All right, it is possible to do multiple accounts and but only if you've got multiple amounts in your P&L. All right, so it's all grouped in the P&L. So something else that might be grouped, so that's employee and other expenses. So it might have, you know, admin expenses or selling expenses that you can specifically attribute to a particular asset or liability. All right. Now, if you wanted to use the formula to work out your cash from your operating activities, you start with your cost of sales, add in your expenses from your profit and loss, minus out the discount received, minus out the decrease in inventory. Remember, if it's an increase in inventory, you would add it. We've got an increase in accounts payable, we minus that out, but if it was a decrease, you'd add it. All right, so depending on, remember, I'm just highlighting again, and this is where it gets confusing if you use the formula. And how this, you can see how easy it is to get confused in the exam, right? If you're under a bit of stress and under a bit of pressure, I can't remember what you do with your plus or minus unless I go and look at my notes. I forget. All right. So if I forget all the time, chances are you're going to forget in the exam too. All right. And that way, but everyone's different. Everyone's brain works a little bit differently. Some people are very, very proficient at being able to memorise whether you're going to increase it or decrease it or not, okay, and be able to go through and do that formula very, very quickly and not get confused, all right? But if you want to, you can see it's actually a lot quicker. It's actually a lot quicker to use the formula, but that's if it is simple. When it starts to get a little bit more complicated, you're adding and minusing a few more things, then it starts to get a little bit more complicated. All right, so you have to work out which is easiest for you. For me as well, If you've got the little T accounts, if you're out by a certain dollar amount, it shows up much quicker in the T account. And you might be able to, if you've got your debit or credit on the wrong side, it might actually show up a lot quicker than looking at the formula and whether something is plus or minus. All right, maybe it might show up a bit quicker. So you have to decide which you want to do. All right, so we've worked out our cash receipts from our customers. We've worked out our cash to our suppliers and employees. Now we've got our core cash generated from operations of 46,700. Now we have to have a look at our interest paid and our income tax expenses. So we have a look at our interest payable. We have, go to your balance sheet, do your opening and closing balances from your interest payable. So your opening balance there of 3, closing balance of 4, interest expense from your P&L of 18,400 means that our cash component of interest paid is 17,400. Okay, again, you can do a little formula for that. Your current tax, this is where it gets a little bit more complicated because we've got 3 tax accounts we have to account for. You have your current tax liability, we've got deferred tax asset and deferred tax liability. Your current tax liability is a liability account, so the opening balance is on the credit side, right, and your closing balance on the debit. The same with your deferred tax liability, your opening balance is on the credit side, your closing balance is on the debit. Your deferred tax asset is an asset, your opening balance is on the debit side, closing balance is on the credit side. Then you add in your tax from your profit and loss. Your tax component from your P&L was 14,400. All right, add that in. Your credit side is the biggest side, and you must have paid a cash component of tax there of 15,000. All right, so you've got to account for the movements in your current tax and your deferred taxes. So if we net them all off, that current tax component there is 15,000. Again, if you want to do the formula, you start off with your income tax expense from your profit and loss. All right, so you'll notice from the other ones, all your formulas, you're starting off with your P&L figure, plussing or minusing increases and decreases in relevant asset liability accounts. All right. Add the decrease in your current tax liability, add the increase in your deferred tax asset, minus the increase in your deferred tax liability. That gives you that 15,000. All right, so we've got those net cash from your operating activities of 13,900 all ticked off. Okay, so now we've got to look at our cash flow from our investing activities. So let's look at our interest receivable first. So interest receivable is an asset account. Right, opening balance on the debit side of 1,800, closing balance on the credit side 1,600. We've got interest income straight from your P&L 4,360 there on the debit side. Therefore, the cash component we must have received must be 4,560. Okay, dividends received straight from the P&L. So we've got dividend income, 7,200. There was no dividend receivable account, right? Had there been a dividend receivable account, you'd have to recreate the dividend receivable account to work out the cash component. There isn't one in your balance sheet, so you must assume that that dividend income was all cash. All right, purchase of equipment. So we read this right at the beginning. Item A, it said 17,400 was paid in cash. Notice it's in brackets. So we're going to pay out that 17,400 in cash. All right. We're also going to recreate our account just to go through and double check. So our equipment account here. Right. We've got our opening and closing balances. We've sold 42,200. So notice on the credit side of the asset, because we've sold it, it's no longer there. Right, we've also got that finance lease liability. All right, so there's no other cash purchase, it's just that 17,400. Right, we haven't bought anything else that's not been listed. All right, so we've recreated that just to make sure. Okay, purchase of building. So that purchase of building, remember we looked at it before, right at the beginning, there was a movement in the building account. So if you go back to that building account, it went from 240 to 360. Therefore, we must have purchased 120,000. All right, so we've got an outflow there. So notice how we've got brackets around that, 120,000. Then we're going to have a look at our proceeds from investments and our proceeds from sale of equipment. All right, we also need to do a note disclosure for that finance lease, for that $50,000. Okay, so let's have a look at our proceeds from our sale of investments. So let's have a look at our, we've got our share of investments. So remember we looked at that before. If we had made a gain on sale, you don't actually need to recreate the T account. If you'd made a gain, means that you must have got more than what they were worth. Their original cost was $32,200. Right, you've made a gain, so you must have received a cash component there of $54,800. Right, because they were originally cost $32,200, you made a gain on that sale of $22,600, so the cash component must have been $54,800. The sale of equipment is the opposite, because the carrying amount was $20,000. All right, but we've recognised a loss there of $1,600, so your 20,000 minus that 1,600 means that your cash component there is 18,400. All right, so you don't actually need to recreate the account. You just understand that if you've made a gain, you've received more than its carrying amount. If you've got a loss, you've received less than the carrying amount. Okay, so debentures. So we've still got those debentures to account for of 30,000. All right, so we need to highlight that we've got an inflow there of 30,000, and there's also a movement, that movement in our share capital that we have to account for. Okay, so your proceeds from share issue must have been 21,340. Your proceed from debenture issue is 30,000. Again, straight from the movement. We're going to do a double check on our dividends. Like I said before, we recreate our retained earnings, but we highlighted before that the movement was 12,760, so we can't have paid any dividends. All right, but always do the check. All right, now let's see that it all balances back to your 36,400. So you've got that in front of you. We've ticked off each item as we've gone through. We have got a net increase in cash and cash equivalents of 12,800. Your cash and cash equivalents at the beginning of the period was 23,600, right? So we had an opening balance of 23,600. We need to flow that through, add on that net increase of 12,800 to give us a 36,400. So our statement of cash flow balances. Okay. On the last page, we've got the note. All right, which is the indirect method. So if we use that, notice how in this note we're going to start. So you're on page 8 on your handout. We're going to start with our profit before tax of 27,160. Right, depending on whether you use your profit before or after tax, right, you can use either. Right, but it depends on, that means that you're just going to have to add or minus maybe some, different tax items. All right, you might have to add them and minus them differently depending on where you start from. So we're going to start from the profit before tax, but you can actually start after tax. All right, it just means that you're going to have to add tax back, can't you, to be able to get it to reconcile. So we need it to reconcile to the 13,900. So if we go back to our cash flow statement, that net cash from operating activities of 13,900, we're going to reconcile to that, but we're also going to reconcile to the 46,300. So your cash generated from operations, the 46,300, and the cash from operating activities of 13,900 will reconcile to both of those points, and you can see we've done that in the answer. You can see down the end, your cash generated, the 46,300, we've reconciled to that. And we've also reconciled by adjusting there for your interest paid and your tax to the 13,900. All right. So if we start with our profit before tax of 27,160, remember if we go back to what we just did first this morning, we've got to add back our non-cash items. So we've got depreciation there that we need to add back. Then we need to adjust for non-operating items. Right, so we've got a loss on sale of equipment. We've got a gain there on your share of investments, that as well. All right, so let's just go through it one by one. Profit before tax, 27,160. Your depreciation on your equipment and buildings, straight from your P&L, 10,500 and 9,900. We've got our loss on sale of equipment, which is a non-operating item. We need to add that back, 1,600. Because we're adding it back because in our P&L we've taken it off, haven't we? Because it's a loss, so we've got to add it back in. We've got an interest expense there of 18,400 that we need to add back because we're not treating that as an operating item. Your gain on sale of your investments, it's an investing item. It's a gain, it's currently in there as revenue. We need to take it out, so it's a minus. Your interest income, right, we're going to take that out. 4,360. Dividend income, it's currently in there as an income. We want to take it out because it's non-operating, 7,200. So right, you can put a line there. So those first ones, those are your adjustments for non-cash and non-operating items. So just put a line under that 7,200, write a note. Next to that, those are non-cash, non-operating items. So they are non-cash and items that relate to either investing or financing activities. The items below are the movements in your balance sheet items that relate to operating items. So we've got a movement there in your accounts receivable, right? So we're going to minus out increases in assets. We are going to add your increase in your allowance for doubtful debts. We've got a decrease there in your inventory. We're going to add that back. There's an increase in prepaid expenses. We're going to minus that out. We've got an increase in your accounts payable. We're going to add that in. We've got an increase there in accrued expenses, and we're going to add that in. Add them all up, adds up to your 46,300. We're going to minus out our interest paid and our income tax paid to reconcile to the 13,900. All right, so really just taking it straight from there. Okay, so there it is in front of you. So those items, the first lot of items, the first group, they are non-cash, non-operating items from the profit and loss. Right? Any items of revenue that are in there, we need to take them out. Any items of expense, we need to add them back. The second part is your adjustments for movements in the balance sheet, but only for items related to operating activities. So that's your accounts receivable, your accruals and prepayments and other payables. So your receivables, your payables, your accruals and prepayments, anything that relates to core operating activities. All right, and that reconciles back to your operating. And then we do it, your cash generated from operations and then your net cash from operating activities. Okay, so it's a lot to take in. All right, so you just got to remember when you're doing that reconciliation, you add increases in liabilities and you minus increases in assets, or the opposite. You will minus a decrease in a liability, or you would add a decrease in an asset. So it goes the other way. Sorry? That's okay. So that's enough for today, and we're out of time. So there's a lot to take in, but you can see we're just adding a little bit of complexity, adding a little bit more, adding a bit more. So there'll be a little bit more each week, so you need to make sure you keep up to date with it. Now, does anyone have any questions about cash flows or assignments or anything like that? All right, so I'll just turn this off. If you've got questions about the assignment or whatever, we can I can answer them for you now. I'll just put this on hold.